few weeks ago, I did a video attempting to explain the differences between drawdown, annuities, and something called UF Plus. That video clearly left you wanting more because there were a load of comments asking for a part 2, and specifically to include some examples. Well, your wish is my command. Hi and welcome back to the channel. My name is Pete Matthew. I'm a 20-odd year veteran chartered financial planner based here in the UK, and I spend most of my time helping people make the transition into retirement and helping them to get their pension benefit decisions right. So let's look at some examples of how they might do that, and these examples use all of the 3 main options for taking benefits from a pension. As always, there are chapter markers in the timeline of the video, so you can skip ahead if you like. And we're going to jump into the computer. So our first example is Tina. She is age 60, right at the end of March, because that makes things nice and easy for the tax year. Her state pension isn't going to kick in until she is 66, so she's got 6 years of zero income. She's got a pension fund of about £500,000, which she's built up over her career, plus she's got some other investments totaling around £200,000. She has the opportunity to buy her company car from the firm that she's retiring from, plus she'd like to go on holiday to celebrate her retirement. So total outlay for those 2 items of expenditure, about £25,000. Her partner, Joy, is a few years older. She's got a decent NHS pension paying out, and that covers pretty much their baseline expenditure needs, but they would like to spend more than that and really enjoy living a little bit more extravagantly. So Tina's got a few things she can think of here, but her main points really is that she's got no income. So her personal allowance is going begging. Right now, April 2022, that's £12,570 per year she can earn without paying income tax. And that allowance is going to stay that same amount until April 2026. She has an immediate capital need. She wants to spend some money on a car and a holiday. Plus, she wants to take some income as well. She doesn't have any lifetime allowance issues to worry about. Okay, she's nowhere near the lifetime allowance with her pension provision. But she has a couple of options here. So she could crystallize part of her pension, say $100,000. And the diagram here, we've got pre-retirement in this first column, post-retirement, which I've just titled as drawdown. Then we've got money for capital needs and income needs. So if you think about it, to the right of this big thick line is her bank accounts, essentially, where she spends her money from. So Tina could crystallize £100,000 of her pension fund and release $25,000 of tax-free cash. So that could come across there to her capital needs and be spent. Goes to buy the car and the holiday. The balance here, which is $75,000, that's in a drawdown pot. It's now in the middle column. That remains invested, and while there's money in there, that's outside of her estate for inheritance tax purposes. The other £400,000 of her pension fund, which isn't crystallized, that can grow for the future, and of course that's also not in her estate for inheritance tax should she die. She draws $12,570 each year for 6 years until her state pension kicks in, and then she can make some decisions again. But she does that, and over time, of course, depending on growth, the pot might disappear. There might be a little bit left. But eventually, once her state pension kicks in, she can make some further decisions. Now, the other way she could achieve similar sort of thing is using UF Plus. And she could use her non-pension money, some of this investment she's got up here, she could use that to fund her capital needs. So that would then drop to about £175,000. Then she could take a series of annual UF Plus withdrawals from her pension, uncrystallized fund, pension lump sum. She could start those at $16,760. The reason for that figure is that 25% of that would be tax-free cash. That's the little pink line there. And the rest, as it happens, would be $12,570, which would fall within her personal allowance, and so she would actually pay no income tax on that at all. So that's £16,760 of tax-free income, in inverted commas, because it's a withdrawal. Tax-free income she can enjoy each year. And she can continue doing that. So this one gets spent, she takes another UF Plus, comes across here, gets spent. She takes another one, and eventually she's done that for 5 years. There's 416,200 odd left in her uncrystallized fund, assuming there's been no growth. Hopefully there would be. But she's met her income needs for the first 6 years and done it using OFF+. Importantly, at no point has any money gone anywhere near a drawdown account, so she hasn't had to even open a drawdown account. The money goes straight from her uncrystallized pot into her bank account so it can be spent. And really, there's nothing to choose from either of these options. They end up taking the same amount of money from the pension over the 6 years. Drawdown is easier to set up monthly withdrawals. Some providers can facilitate regular OFF+ payments, but each payment is a crystallization. So you'd need to log those and keep an eye on how much of the lifetime allowance you are using with each OFF+ crystallization. That's assuming, of course, you're anywhere near the lifetime allowance, and that's going to be an issue for you. If not, it doesn't really matter. But crucially, OFF+ is really intended to be an ad hoc method of withdrawal rather than a regular option. There is a third option. She could go for a temporary annuity. So here, again, she uses her investments to pay for her immediate capital needs. And then she crystallizes £75,000 of her pension. She could opt not to take tax-free cash. You don't have to. So she could take that $75,000 out, and she could use that to buy a fixed-term annuity. $12,570 for 6 years. It's going to cost her around £75,000. Now, crucially, the £75,000 is gone. Right? It's gone, it's disappeared, it's been used to buy that annuity. But her income has been guaranteed, and if she's a really risk-averse person, that might appeal to her. She's left a little bit more uncrystallized here, but she has foregone some of the tax-free cash available to her. So hopefully you're getting the idea. There's plenty of ways to skin the crystallization cat for any individual, really. By the way, if this is helpful, you know what to do. Hit the like button and subscribe to the channel if you're not already. It takes like 0 seconds of your time and really helps me out. So thank you. Okay, next example. This is Tony, and Tony is divorced. He has 2 grown-up children. He's 67 years old and just started receiving his state pension of £180 a week. That's about $9,400 a year. He's got a rental property, which pays him about £6,000 a year after all costs. So he's already, if you add these two together, he's already over the personal allowance. Since retiring a couple of years ago, he's been living off a small inheritance from his late mother, and he hasn't yet touched his pension fund, which is a pretty significant fund at £950,000. Now, he's always fancied an RS6, an Audi RS6, man after my own heart. I don't have one. I wish. And so he's going to spend $100,000 on a car. He wants to leave a decent legacy for his kids one day, but that includes making some lifetime gifts. He would like to give both of his kids £25,000 now. So that's around $150,000 of initial capital outlay. And he reckons that after that, he needs about 40,000 quid a year net to live on, so after tax. So key points here. Tony doesn't have any personal allowance left. So any taxable income he takes is going to be taxed at 20% and more potentially if he goes over the higher rate threshold. He doesn't have much money outside pensions, crucial point. He's edging close to the lifetime allowance, so we're going to need to watch that. He needs $150,000 now to buy the car and make the gifts to the kids. His income is around $15,500. He wants $40,000 a year to spend. Some fairly simple maths means that he's going to need to draw around $32,000 a year gross from his SIP in order to work out, with added to his other income, around £40,000 net. So, again, drawdown. So his uncrystallized fund is $950,000. He's not got a whole load in investments over here, but he could crystallize £600,000 of his pension pot. He could take £150,000 tax-free cash. That comes across here, and he gives that to his kids. And buys the car. The remaining $450,000 here, that goes into drawdown, and from that he draws $32,000 each year, rising by inflation. He's going to pay some basic rate income tax, of course. Now, £350,000 of his pension remains uncrystallized over here, and from that he can take 25% of that as tax-free cash at any point down the line. Of course, while it's growing, he's locking in more tax-free cash. So right now, with the pension fund worth $350,000, there's $87,500 of latent tax-free cash in there. But if the pot grows to $500,000, well, then potentially there's another $125,000 he could take as tax-free cash there. But be careful, we're going to talk about the LTA in a minute. So given that he wants to leave as much to his kids as he can, it doesn't really make sense for Tony to buy an annuity, because then his pension fund is used up. There's nothing to leave to his kids. Yes, you can buy annuities with an element of inheritance protection, but that adds significantly to the cost. Now, he could take off pluses again each year, but Tony is not a man who likes hassle, right? He doesn't want to have to spend any more time dealing with his pension company than he can help. So let's just think about lifetime allowance here. So we just simplify. We've got pre-retirement and post-retirement on either side of this line. Well, when Tony crystallized £600,000 of his pension, that used up 55.91% of his lifetime allowance. Right now, the LTA is 1.0731 million. So he has 44.09% of the LTA remaining to him. His uncrystallized pot will be crystallized when he does crystallize it down the line, or if he dies before age 75, or if he makes it to age 75 without having died. So right now, with a value of $350,000, that would fall within his lifetime allowance. So there would be no charge. But if it grows, he could potentially go over the lifetime allowance and be charged. Now, any growth on his crystallized pot over here gets tested again at age 75, but it doesn't get tested on death before age 75. So that might suggest that Tony crystallizes more earlier, perhaps. And I think actually, if I was advising Tony, I would definitely be considering fully crystallizing his pension. So that releases £237,500 of tax-free cash. $150,000 goes to buy the car and gifts to the kids. The balance can be invested, so that provides another pot that he can draw from in the future. That money is now in his estate, though, so depending on the value of his other assets, might be subject to inheritance tax. The full crystallization of $950,000 is within the lifetime allowance, so there's no charge payable. The drawdown pot starts at $712,500, from which Tony draws the $32,000 a year that he needs to live on. So that's a withdrawal rate of around 4.5%. So Tony's going to need to manage the investments carefully in order not to deplete his pension fund altogether. His life expectancy is going to be between 18 and 20 years, so there's a good chance there will be something left of this crystallized pension pot to leave to the kids. And remember, that money is outside of his estate. Now, any excess over $712,500, if there's growth on that pot, it will be tested again at age 75 against the lifetime allowance. But given that he's drawing against it, it's probably unlikely that it would grow too much and that he would have a lifetime allowance issue. He does have a little bit of the lifetime allowance left, remember. Now, if Tony dies before age 75, this excess is not tested. And if Tony dies before age 75, the whole lot can be left to his kids tax-free, either as a lump sum or as an inherited drawdown. So it strikes me that for Tony, there's merit in crystallizing more earlier. So well done if you've stuck with me so far. We're going into our third and final example, which is Jane. And Jane has worked at the same company for her entire career, ending up as a senior manager. She's married to John. John was a mechanic, but he had to stop work in his 40s due to an accident at work. So Jane has been the only breadwinner for the last good few years. She's now 60 and about to retire. She has a DB pension scheme. That's going to pay her £40,000 a year plus a lump sum of £200,000. She's saved all her life, so she's got a SIP as well, worth $550,000, $100,000 in premium bonds, $50,000 each between her and John. They've got a little bit of cash in deposit accounts as well. They have one grown-up child and 3 grandchildren who they want to spend more time with, but who live away. So while John and Jane love where they live, they are thinking about maybe buying a flat closer to where the grandchildren live, or maybe a decent-sized camper van so that they can take it up, spend some time with the grandchildren, maybe even take them away on holiday. Jane reckons she needs another £10,000 a year on top of her DB benefits in order to live the life that they really want to live. And when their state pensions kick in a few years' time, they want to just enjoy that money. They want to really live it up while they've got their health. Now, importantly for this example, both John and Jane are incredibly risk averse. They don't really understand investments. They don't have any investments other than the pension, and their financial advisor just looked after that for them. Jane just wants to make sure that they have all the income they need, and importantly, if she dies first, that John has all the income that he needs. So here's what she could do. Firstly, she takes benefits from her DB scheme. So that's £40,000 per year, indexed for life, and a £200,000 lump sum. Now, for lifetime allowance calculation purposes, that £40,000 income from the DB scheme is multiplied by 20, which gives £800,000. Then the lump sum of £200,000 is added to that, which gives us £1 million. And that's within the lifetime allowance. It's 93.19% of the lifetime allowance. And because it's within the lifetime allowance, there's no charge. She uses the Money Helper annuity comparison service, I'll put a link to that in the description, to determine that to secure this extra £10,000 worth of income that she needs, rising by 3% per year and continuing to pay in full to John if she dies first, the cost of annuity on those terms is going to be £400,000. So pretty hefty cost, but it secures the income that they want. So she decides she's going to fully crystallize her SIP and use it to buy an annuity. Now, as you can imagine, this crystallization is going to take her way over the lifetime allowance. Now, the first $73,100 of it is within the lifetime allowance. So we'll deal with that bit first. Of that, you can take 25% tax-free cash, which is $18,275. So that leaves $54,825 crystallized and ready to buy the annuity with. So that's this pot here, waiting to buy the annuity. I've just renamed this column annuity pot, and we've taken a little bit of tax-free cash out. Now remember, you can't take tax-free cash over the lifetime allowance. And so this whole pot now is going to be subject to the lifetime allowance. So $476,900 of remaining fund is going to be chargeable. Jane asks the scheme to pay the lifetime allowance charge, so it's at 25%. $119,225 in tax to pay. Eye-watering. But that leaves $357,675 crystallized, plus the $54,825 from the previous step. And so we have a pot of £412,500 sitting here, ready to buy an annuity. And so she does that. She now has an indexed annuity of £10,000 per year, payable in full to John if she dies first. But there's no pension fund left at all. So she's obviously not going to have any further lifetime allowance charges at age 75 or anything because there's no pension left. Now, you might argue that 119 and a bit £1,000 of lifetime allowance charge is a lot of tax to pay, and it is. But for Jane and John, their priority is to secure their income. So for them, it's a price worth paying. Now, of course, in the example we just used, Jane takes her benefits from her DB scheme first and then from her SIP. But what if she did it the other way around? Well, in this case, she would crystallize the SIP of £550,000 first. That's all within the lifetime allowance, so there's no charge. But then her DB scheme would take her over the LTA by the same amount, $476,900. The lifetime allowance charge would be the same, $119,225. But she could ask the DB scheme to pay the lifetime allowance charge for her. But if they did, they would reduce her income. They would commute some of her income into cash to pay the lifetime allowance charge. Now, it might be the case that her tax-free cash is reduced. Now, it might be the case that her tax-free cash is reduced, but it might be that the scheme rules don't allow that. And so we end up in the murky waters of DB scheme rules. And so really, in this case, I can't imagine that it would make sense for Jane to crystallize in this order, because to do so would reduce her income. And remember, for John and Jane, securing the income is the most important thing. Okay, folks, we've dived right into the deep end there, but hopefully you can see there's always a lot of moving parts when it comes to retiring. And actually having more wealth creates more options, more problems, if you want to call them that. But I would argue that things like lifetime allowance charges and orders of crystallization, these are nice problems to have, right? So I could have probably come up with 100 or more different scenarios, but you certainly wouldn't have wanted to watch that video. This one's already 20 odd minutes long. But I hope it was helpful. Let me know what you think in the comments. I'll do my best to answer any questions you've got there as well. But if it's been helpful, or even just in recognition for having created a slide deck with 60 odd slides in it, smack the like button for me and leave a comment subscribe to the channel if you haven't already. All those things really help. So thank you so much for watching, and I'll see you next time.